Yeah, so look, I think that there's a couple of shorter term aspects to look at the moment. The first is that the impact of central bank shifts on sectors is going to be quite different. And so you're going to see different dynamics across defensives and cyclicals. One thing that's interesting in the last couple of months is that European defensives have become very expensive. Given where all the macro information sits and how it's evolved, when we look at sort of staples, they're very expensive to industrials. And one of the things that's been happening here is that as markets became a little bit more worried in the last 6-7 weeks about central banks tightening financial conditions, global investors moved more defensive. And that is overdone as far as our sort of model outputs are concerned. And what's interesting is it's not just the equity asset class that shows this. When we look at our FX models, we see that safe havens like the yen and the Swiss franc have also become disproportionately expensive to the current information. And so one example is simply looking at, industrials over staples over the next couple of months as an interesting play. We've also seen that as this Fed fear and central bank fear grew, the positioning data indicates that global investors have also de-risked. So we're going into 2022 with positioning lighter, probably a little bit too defensive. Central banks, one of the most interesting things we've seen when we look at the data is that hikes from central banks, such as the Fed, are not a problem for equities. What really matters is the pace of those hikes. And indeed, when we look at the dynamics of markets and all this data, what they reveal is that equity markets prefer central banks to go early and gentle, as opposed to central banks doing nothing for the next year and then hitting the brakes hard. That clue comes from the way the yield curve is shifting. So as we price in central bank hikes and we see a flatter yield curve, that's the market telling us that central banks are ahead of the curve. They're going gently, they're keeping a lid on long-term growth. If we started to see central bank expectations increase, but the curve steepen, that would be a real problem, because that would be the market saying central banks are behind the curve, they're going to have to go faster, and that would hit equity markets. So when you add up all these quantitative clues, what it tells you, bottom line, is that as long as central banks go gently, and I think they will, they've got form on going gently since the financial crisis, that's not going to be a problem for equity markets. But we're probably not going to see the type of sharp ratios and the type of enormous returns that we've seen in the last year or two. It's going to be a bit more difficult. It's not going to be such a one-way bet. You're going to have to get your sectors and regions right.